Welcome back to the Alt Goes Mainstream podcast. Today's conversation features a live podcast from BTG Pactual's New York office for an audience in private markets. We are joined by Todd Owens, the co-founder and managing partner of Cantilever Group, where BTG Pactual is an investor. Cantilever is an independent firm focused on providing capital solutions to middle market asset managers. Their capital can be used to accelerate growth, support acquisitions or liftouts, fund GP commitments, seed new strategies, facilitate generational ownership transfer, and provide liquidity to founders. They focus on asset management businesses that have enterprise values between $50 million and $500 million. The team has executed on over $500 million of GP stake, financing, and seeding transactions as both investors and principals. Cantilever is working with two strategic partners as they build their firm: BTG Pactual, the near $30 billion market cap Brazilian bank and wealth and asset manager that has invested in Cantilever's fund, and Broadhaven Ventures, the principal investment arm of Broadhaven Capital Partners. Todd has over 30 years of experience as an advisor covering financial institutions and as a senior financial services executive. Prior to founding Cantilever, Todd has been a partner at Broadhaven Capital Partners, an independent financial services-focused investment bank that's completed over $100 billion in announced M&A transaction volume, as well as being the former CEO of Fifth Street Finance. Todd began his career at Goldman Sachs, spending 24 years, including as a managing director and partner in the investment banking division. Todd and I had a fascinating conversation about the GP stake space and why the middle market represents a compelling part of the asset management ecosystem as the industry undergoes change and consolidation. Thanks, Todd, for sharing your wisdom and views on GP stakes and asset management.
We're going mainstream.
Welcome to Alt Goes Mainstream Live. We are here at BTG Pactual. We have an audience. So welcome to the podcast, Todd.
Thank you. Thanks for having us. And thanks everybody for being here. It's a nice setting. Would be better if it was still light out, but still it's a nice spot to be. Appreciate everybody coming.
Absolutely. Well, great to have you. Want to talk about the GP stake space, the evolution of alternative asset management in the context of why GP stakes is now seemingly to some extent the forefront of the conversation, in part because the business of asset management has changed. You had a front row seat at that. Would love to start from the context of hearing your background and perspective working at Goldman with some of these alternative asset managers when it was not necessarily thought of as popular to go public.
I'm happy to start there. And as you know, and some of you also know, I started my career at Goldman and I covered asset management businesses for most of that 25 years on the West Coast. And so did have a front row seat. And actually, when I met my partner, David, and he described what he was doing, it immediately resonated because I'd run processes where we couldn't find a minority equity investor. And so wrap your head around Oaktree in 2001, we called everybody. There was nobody that would take a stake in Oaktree. And the rumors started spreading, and Howard wrote a memo to his LPs and said, it's true. We started this process to go find a minority investor. And he diplomatically said, we couldn't find one that made sense as a strategic partner. And a bunch of his LPs read that memo and called him up and said, we'll do that deal. And so that's how that minority stake deal got done. But back then, which is now a long time ago, more than 20 years ago, there was really no minority equity available to the space. And then a few years after that, we went through, which is something that's also, I think, really interesting today. We went through a phase where there was an open question about whether alternative asset managers could go public. But there was a widely held big discussion about, no, these are investment partnerships, they're not businesses. And that was an uphill battle. People were worried to go public. What do the LPs think? What happens next? And so that was a big debate, and people take it for granted now. We've got these huge publicly traded alternative asset managers like Blackstone and KKR and Carl, all those names you know. But in 2004, a lot of people thought it wasn't even possible to do it. We spent a ton of time building the framework for a business to go public and spent years of my life that I will never get back with a firm that waited a very long time and is now public. And I won't name any names, but they finally got with the program. But at the time they said, no, we're not going to do that. And then Fortress, the opportunistic, kind of said, we'll do that. And we just gave up. Goldman said, here's the book. And they went public. And that's what started a lot of the public offerings. But getting back a little bit to the evolution of the market, as it relates to GP stakes, there was no minority equity. The only minority equity investor that was reliably present until mid 2000s was really AMG, and they had a quirky structure. It was awkward. There were a few others who dabbled here and there. There were a bunch of deals by strategic LPs into the alternative managers before they went public. And so that's a little bit of a starting point. But the market itself really didn't take off as a asset class or a market until right around the financial crisis or just a little bit after that.
Was that because there was a lack of belief in the business model of asset management?
I think it was people didn't understand, and still to this day, I think there's a lot of it. There's more people that do understand it. It's become investable. You still run into a lot of investors that aren't persuaded that it is a classic investment. There's still an uphill battle when you're talking to some LPs, and indeed when you're talking to some potential investees, some potential affiliates. There's some of the concerns or criticisms that I remember from 2002 and 2004. You still see some echoes of that today in the market.
So was there a point at which the market started to grasp that these are high quality businesses and people started to see these businesses as investable, both public markets and in private markets?
Yeah, and the answer to that is a little bit different. In the public markets, it really was the success of these companies going public that started to move the needle. And then there was a second event, which was when these alternative asset managers changed from publicly listed partnerships or Up-Cs to just C Corps. And all of a sudden, the valuations took off and the remaining naysayers kind of caved in. And it was at that point really in the public market that people realized that these were real businesses. The other thing that's really interesting, if people go back to pre-IPO, the list of the top private equity guys in the country is not the same as it was today. There were a couple of notable private equity firms that didn't go public in the first wave and were really behind as a result of that. And I think that fact pattern also impacted not only that these are real businesses, but that they need access to the capital markets and they can grow in that way. And so in the public markets, that's what happened. And there are still some large private equity firms that haven't gone public, but at this point, most of the largest ones have. In the private markets, really, I think, followed on that private markets, particularly in the minority stakes, became investable. And it really was Dyal's third fund, which was the first fund that was really committed to investing in alternative asset managers as opposed to hedge funds. There were some other predicates, but that was really the start of the feeling that GP stakes was the legitimate investment structure and approach.
How much of GP stakes became something that was necessary for firms to grow? Because I think one nuance to GP stakes, a lot of people think of it as cash out. But the reality is, and I'm borrowing from what Sean Ward, who was at Blue Owl, has said on the prior podcast on What Goes Mainstream, was that it's really a cash in. And it's in large part because firms grow to a size and scale where they actually need to be able to invest themselves.
The answer, as I'm sure you would anticipate, is it varies quite a bit. And there's a range, and I tell this story occasionally, but I was always struck kind of midway in my career when I was advising Oaktree and Ares. And both of those wildly successful teams, great management, adore those guys almost uniformly, very different approaches. Tony Ressler at Ares really set out to build a business. He was building a business. It was all on a spreadsheet and it was all laid out. And it was like, next year we're going to do this, and the year after we're going to do this, and we're going to launch this fund, and we're going to do this. Meanwhile, Howard Marks and Bruce Karsh viewed themselves as investors. They viewed themselves as mining the world for great investment opportunities and came to realize that they had also built a business. And you see that today. There are some businesses that are very deliberate about it. And there are other businesses where they've really kept their head down and focused on investing. And it's not that bipolar, if you will. I mean, everybody has to be a good investor and kind of good at building a business, but there's different mindsets there. In our travels, the level of sophistication is all over the place. There are folks that are extremely sophisticated who have a vision about where the market's going and a way of pursuing that. We could fill in names there. And there are others that are earlier on in that, where they've been wildly successful raising flagship funds and are only just starting to think about, what do I now do with this? Should I be in an adjacent strategy? Should I be in a different fund structure? Should I be targeting a different LP base? And so that also varies quite a bit.
Now that GP stakes has become more mainstream and more people understand asset management as a business, do you think that the skill set of managers has changed, or do you think that more managers think strategically earlier on?
Because alternatives has become a thing with real tailwinds and press all the time, and people are even doing podcasts, I think that there is more of an understanding of what the opportunity might be. And so people are a little bit more deliberate about it. I think we were talking about David Bonderman earlier when he founded TPG. I don't think he had a vision of, I was going to build this enormous business. He just wanted to make private equity investments that made sense. I think David Bonderman in today's market, if he could be, unfortunately he's not, but if he could be, he would probably see, it would just be more apparent that there was a bigger and a different kind of opportunity. And so I do think that you can call that sophistication, you can call that how the market has evolved, but I do think that that's a real thing.
Well, talking about evolution of the market, sophistication of the market, there's both the upper end of the market and there's the middle market. Walk us through some of the differences in those markets and what they look like today.
This is not going to surprise anybody either. The larger firms are more sophisticated. They have staffs, they have strategic planning people, they have, it's all built out. These are businesses that have hundreds and hundreds of employees. And for many of those businesses, it's not clear to me that a minority equity investor can bring a lot to the table. They can help here and there, they can make introductions, they can share best practices, and they do those things. But those businesses are large and sophisticated, and it's hard to tell them anything about their business that they haven't already thought about. In the market where we are spending our time, the middle market, the businesses are real businesses. They are institutionalized. They are on their third or fourth fund, but there isn't a strategic planning staff. And although they are cognizant that there are huge opportunities, they have not had the bandwidth in many cases to really push on those things. And so in our business, we like that because that is an opportunity to bring to bear the experience of me and my partners who have been advising these firms for literally decades about what works, what doesn't work, what we've seen, and how to do that. And so that opportunity in the middle market is much greater. It's a little bit ironic because when David and I were imagining building this business, we looked at a lot of, I won't say commitments, but efforts by GP stakes investors to really bring value as a part of their stake investment. And so we went away from that. We said, we're just going to be passive. Our capital by itself is strategic. But as we've gotten into the business, the irony is there's a lot that we can do to help these firms for the reasons that I just said.
So talk about some of the differences between the upper end of the market, the middle market. One of the other differences is there's one investor, Blue Owl Dial, that has invested, I think, and controls like 60+% of the market. That's at the upper end of the market. The middle market is much less trafficked. What is the size and scale of that market look like, and why has it been so less trafficked?
We really stratify the GP stakes market as Dial, everybody else in kind of the middle market. And we can further stratify it if you want, but it's not useful here. And then the market where we're focusing, which is smaller firms, we can call that the lower middle market if you want. And most of the capital formation has been really in the middle market. So of course, Dial is, the 600-pound gorilla in the space, but most of the other firms have formed in kind of what I'd call the traditional middle market, and they describe themselves as middle market firms. And there's a lot of those. And the opportunities there are still, I think, significant. It's an interesting place to be. As you get smaller, there's a lot of advantages to focusing on smaller deals. There are fewer firms that are focused on this market. And so that has a lot of implications. It means that you can structure deals that make sense. It means that you can spend more time getting to know teams and how you can be helpful in developing a rapport with them. It means the prices are lower, and they should be lower because these are businesses that are riskier in many ways. And so all of those things are true of the market that we're focus on. The other thing that's really interesting is the diversification of the business models in this market is much greater. If you're Dial, you don't have an opportunity to invest in a more esoteric or off-the-run asset strategy because there just aren't any that are big enough. But in our market, there are a lot of interesting firms that way. And so we think you wind up or have the opportunity to build a portfolio that is more diversified across different asset classes and different business models than certainly Dial can or has, and to a considerable degree where the middle market is focusing.
Do you think the middle market will still continue to persist? And why I asked that question is Partners Group CEO Dave Layton a year ago or so said he thinks that the business is going to evolve from 11,000 plus funds to 100 platforms. And that relates to a bunch of other trends. The wealth channel is becoming a bigger focus for many firms. Only a certain number of firms are actually staffed up and have the ability to serve them properly. There's a whole host of reasons why being a part of a larger platform is beneficial. What do you make of those comments? And how do you think about that relative to the middle market?
Look, it's obvious that the largest firms are gathering a disproportionate share of the investment dollars. But I think it's also true that new firms are being created at a very rapid rate. And that I think that will continue for a long time. There are forces at play here, in our view, that challenge that narrative that it's all going to consolidate down to 100 firms or even down to 1,000 firms. And among the reasons are, as alts becomes more available to retail investors and to advisors to retail investors, I think what you're going to see is that those investors want something that's more differentiated than just coming into the 20th fund of a big alts manager. And so you're going to see, in our opinion, the formation of a lot of these firms, and those firms are going to thrive. Many of the firms we look at are going to thrive for 10 years and sell themselves, right? And be part of that consolidation wave. And I think ultimately at some point in the future, you will see a decline in the number of firms. But I think over the next 3 to 5 years, I will bet that in 5 years, there will be more alternative asset management firms than there are today by number. And I think that may continue for some time after that before the consolidation wave really starts to change those dynamics.
You bring up an interesting point, which is it feels like we're at a place within the distribution of private markets to the wealth channel where, thanks to platforms like iCapital, et cetera, access is now table stakes. Any firm can get access to Blackstone, Apollo, KKR, et cetera. Now the larger, more sophisticated wealth platforms are kind of trying to have this balancing act of how do they customize and differentiate themselves while also being able to scale. What do you make of that in the context of all the managers that you talk to, work with? They're smaller, they're more differentiated, maybe harder for them to work with the wealth channel and now there are platforms that enable them to do that. But how do you think about where we are in terms of the evolution of private markets coming into the wealth channel that refers to what you were just talking about this kind of market?
Wealth management industry, if you allow the term, is also evolving very rapidly. It's very different from what it was 10 years ago or 20 years ago. I sold my first wealth management firm 25 years ago. And the model then was to manage everything in-house. You were picking stocks. You had the stock guy and the bond guy, and you had the client guys, and you put everybody in a portfolio of assets or investments that you had curated. And over time, that became open architecture. Over time, a bunch of things changed, but that wasn't that long ago. And there are still a lot of business models out there that are very early on in adopting alts as a part of their investment strategy. There are many firms who are very far along, and there are many who are not yet very far. And so there's a lot of green field we think, in the wealth management or the RIA segment to bring more capital into alternatives. And that's part of why I said earlier, I think that and wealth management is itself an extremely competitive industry. If you're a wealth manager offering access to Fund 17, which is a $20 billion fund, and your clients are 100 million in that, it's hard to market that. It's hard to differentiate that. And so I think that it won't be linear and it won't be perfect, but that democratization, if you will, of alts is going to continue to drive niche strategies that can get very big. But that's part of our overall view of the market, is that that's going to drive growth in our market.
One thing related to that as well, particularly when it comes to the wealth channel, is some of them may be newer entrants to the market. Blue Owl recently put out a report that talked about how GP stakes is kind of multiple flavors all wrapped up into one, right? It's shades of private credit, private equity, and secondaries all in one. You have vintage diversification, you have a reduced J curve because there's a yield, there's elements of private credit, there's elements of private equity because you're owning these firms and they may exit in some way. Like, is GP stakes the best of all worlds?
It's interesting in our seat. One of the fantastic things is we see a lot of really, really interesting investment strategies. And I'm not sure GP stakes is the best. We've seen some really cool stuff where hopefully we're going to get a chance to invest. But we like it a lot. We like it a lot for all of those reasons. It's one of the few investments we think where you've got visible contractual revenues that you can invest against. In a downside case or a flat growth case, you can take a lot of comfort from a 10, 11, 12% yield while you're waiting to see if this business will grow again, but you also have the growth. And so that investment profile, we think, is really, really interesting. And the fact that you can create a portfolio that does have yield, and because we're investing in businesses that have contractual cash flows, but they really don't have any need for capital, but also that has growth and has got the tailwind of some of the things that we've talked about on the alternative side. Now, the bad news is, jokingly, when we talk to people, I say, if you like private credit, we're private credit. We just have growth. And if you like private equity, we're private equity. We just have yield. And so it is kind of a little bit between those two more established asset classes. But it's also, the other interesting thing in contrast to private credit in particular is we are not as directly exposed to rates. And so we think that we can have a portfolio, for example, that you can make investments that have a meaningful yield. And in an environment where you can make an investment that's a 10 or 12% yield, but interest rates are high or moderately high like they are now, maybe that spread is 400 or 500 basis points over like a private credit type yield, at least a sponsor-driven private credit yield. But if rates go down, then GP stakes investments are less correlated to that, and it starts to look a lot better if spreads and yields are lower.
So in its most simplistic form, is GP stakes just a bet on private markets growing effectively?
That's a big part of the bet. It's a huge part of the bet. But it's also a bet on the structure and the long duration of the capital. So there's a lot of bets, but fundamentally the tailwinds in alternatives, which we think are real and we think are going to persist, is a big part of the story.
Well, you mentioned long duration capital. A lot of GP stakes investors have historically been firms who have permanent capital or who have very long time horizons for investment, because at one point it was thought that maybe some of these firms wouldn't exit. Now I think you've seen firms go public. I think there will be a next wave of firms go public. There's also exit opportunities due to consolidation. Do you think this consolidation wave in private markets is creating an environment where there's clear understanding that there are exit options and therefore liquidity in the GP stake space?
Yeah, I think that the issue with liquidity in the GP stake space is you can't really predict it. You certainly can't control it. And so it's a very different dynamic than private equity investing. There are, however, going to be realizations. We just talked about consolidation. There will be consolidation that will and already has resulted in liquidity events for GP stakes firms. There will be IPOs. Those tend to be very cyclical, and we haven't seen a lot of those, but I think we will see more of those. Those will also create liquidity events for GP stakes players. And then there's also management of the portfolio. That's a real thing. You can sell strips, you can back lever, you can do NAV type financing. There's a bunch of ways to accelerate realizations to your LPs. But we still think that there's a need for other solutions in the space, and that those solutions are, although those are real and will come and go in various shapes and sizes. We think that the industry as itself, or the asset class, is still gonna look for other ways of creating liquidity for their LPs.
How does the liquidity question get answered?
Well, I think right now, the liquidity question, the answers for the liquidity question have been insufficient. And the industry, if you'll allow the term for an asset class that's probably 60 or 70 billion, hasn't cracked that code yet completely.
I want to ask a few quick fire questions. First thing that comes to your mind, yes or no answer, depending on the question. No. Favorite asset class to invest in 2025 in private markets?
I've seen a lot that I really like. I'm tempted to say GP stakes because I think it's a really fantastic time. I'm unenthusiastic right now about venture for a variety of reasons. I think private equity, I could get more enthusiastic about it shortly. There are some areas of private credit that I think are quite interesting. And probably that would be my answer. Some not sponsor driven or even direct private credit, but nichier strategies within private credit I think are very interesting right now.
Next firm to go public?
I thought it was going to be HPS, but they decided to sell themselves. So I guess it's not going to be HPS. Maybe a Clearlight?
Do you think there will be 2 or 3 firms, specialists that are, or firms that kind of fit pieces of the puzzle together that are 50, 100 billion plus that end up merging together? Yes or no? Why?
Because I think the complexity of that is absurdly hard. And I think everyone, if you try to put 3 or 4 firms together that view themselves as equals, just where the headquarters is going to be is something they won't agree on. I mean, now if they're all in New York, then they've got to decide who's going to run the thing. And I think that's also not an easy thing. Early in my career, I worked on a 3-way bank merger. And it would have created the largest bank in the country. And it was all terms agreed. And they couldn't agree where the headquarters was going to be. They couldn't agree what the name was going to be. And they couldn't agree who was going to run it. And it was over. We had the exchange ratios done. We were starting to draft the proxies. We're like, nope. And by the way, compared to alternative asset managers, bank management teams are really easygoing. And so I just think that that's really hard.
Middle market is about 10 billion in terms of total capital raised to invest in middle market GP stakes, roughly speaking. In 3 years' time, how big does that become?
3 years? I think it's incrementally bigger. I think the capital raising environment has been challenging. A lot of that capital that you just mentioned has just recently been raised and hasn't really been deployed yet. And so I think that you could see that being 12 or 13 billion. I think in 5 or 10 years, maybe 6 or 7 years, it'll probably double. I think we're going to see some real growth in the space, but I don't think you're going to see another $3 billion GP stakes fund form in the middle market in the next couple of years.
That's a great note to end on. It's been a ton of fun. Live podcast. All right, Warren, this was great. Thank you for having me. Thanks for doing this. Thank you all for coming. We appreciate it.
Thank you guys.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going